Now to our continuing series, Retirement Ready. If you have access to a 401k or traditional pension in your job, consider yourself to be lucky. Nearly 57 million Americans work for an employer that does not offer a retirement savings.
Money makes the world go round, but how much do we really understand about it? From saving strategies to investment myths, our financial knowledge is often clouded by misconceptions. Join us as we expose the most common money myths of 2024 and reveal the truths behind them. The world of finance is complex and ever-changing. With new technologies, economic shifts, and evolving markets, it's easy to fall prey to outdated or inaccurate financial advice. In 2024, several studies have shed light on the misconceptions that still persist, impacting our financial decisions. This video will dissect these myths, backed by the latest research, to help you navigate the economic roller coaster with better knowledge and confidence. One of the most pervasive money myths is that simply saving your money in a bank account is the safest and best way to grow your wealth. While saving is crucial, relying solely on traditional savings accounts may not be the most effective strategy in 2024. A 2024 report by the Federal Reserve highlights the ongoing challenge of inflation, which continues to erode the purchasing power of money kept in low-interest savings accounts. With the average inflation rate projected to be around 3%, and most savings accounts offering interest rates below this figure, the real value of your money decreases over time. This means that while your nominal savings may grow, their actual purchasing power diminishes. To combat inflation, financial experts recommend exploring high-yield savings accounts, which offer better interest rates. However, even these might not keep up with inflation. The 2024 study by the National Bureau of Economic Research, NBER, suggests diversifying your savings strategy. Consider allocating a portion of your funds to low-risk investment options like Treasury inflation-protected securities, TIPS, or inflation-indexed bonds, which offer protection against inflation. A case study from the University of Pennsylvania's Wharton School in 2024 followed two individuals over a decade. One relied solely on a traditional savings account, while the other diversified between high-yield accounts, TIPS, and a modest stock portfolio. The latter individual saw significantly better growth in their real wealth, demonstrating the importance of a diversified savings strategy. For decades, home ownership has been considered the cornerstone of the American dream and a foolproof investment. However, the housing market's volatility and changing economic conditions in 2024 have exposed the risks associated with this belief. The housing market can be highly unpredictable. A 2024 study by Zillow revealed significant regional disparities in home value appreciation. While some areas experienced substantial growth, others saw stagnation or even decline. This variability means that home ownership is not always the guaranteed path to wealth it's often made out to be. Another overlooked aspect is the ongoing costs of home ownership. The 2024 Annual Housing Survey by the U.S. Census Bureau highlights that maintenance, property taxes, and insurance can add up to significant expenses over time. These costs can erode the financial benefits of home ownership, particularly if property values do not appreciate as expected. Given these factors, financial planners recommend considering alternative investments. The same Zillow study suggests that for some individuals, investing in a diversified portfolio of stocks, bonds, and real estate investment trusts, REITs, might offer better returns and liquidity. REITs, in particular, allow investors to benefit from real estate without the burdens of direct property ownership. A 2024 study by the Harvard Joint Center for Housing Studies compared two groups, one that invested primarily in home ownership and another that diversified into stocks, bonds, and REITs. Over a 15-year period, the diversified group saw higher average returns with less financial strain from unexpected costs, illustrating the potential benefits of alternative investment strategies. The allure of get-rich-quick schemes has always been strong, and with the rise of social media influencers and online platforms, these myths have only proliferated. From cryptocurrency to meme stocks, the promise of instant wealth can be enticing but often misleading. Cryptocurrencies have gained popularity as a means to achieve rapid wealth. However, a 2024 study by the Massachusetts Institute of Technology, MIT, warns of the high risks associated with crypto investments. While some have made fortunes, the extreme volatility and lack of regulation make cryptocurrencies a risky bet. The study found that while 10% of investors saw substantial gains, nearly 50% experienced significant losses. The phenomenon of meme stocks, driven by online communities, has also captured public attention. Stocks like GameStop and AMC saw dramatic price swings due to coordinated buying efforts. However, a 2024 analysis by the Securities and Exchange Commission, SEC, highlights the dangers of such investments. Many investors bought at peaks, only to see prices plummet, leading to substantial financial losses. Financial experts emphasize the importance of due diligence and long-term planning over chasing quick profits. A 2024 survey by the Financial Industry Regulatory Authority, FINRA, found that individuals who engaged in speculative trading often faced higher stress levels and poorer financial outcomes compared to those who followed a disciplined, long-term investment strategy. A case study by the University of Chicago Booth School of Business in 2024 followed two investors, one who pursued high-risk, high-reward opportunities, and another who adhered to a diversified long-term investment plan. The latter saw steady growth and lower financial anxiety, while the former faced significant volatility and eventual losses, underscoring the value of patience and strategy in investing. The persistence of these money myths has profound implications for personal finances. Misguided beliefs about saving, investing, and quick wealth can lead to poor financial decisions and long-term economic hardship. Understanding and debunking these myths is crucial for making informed financial choices. To build a better financial future, individuals should focus on education and informed decision-making. Financial literacy programs, such as those offered by the Consumer Financial Protection Bureau, CFPB, in 2024, provide valuable resources for understanding complex financial concepts. Additionally, consulting with certified financial planners can help tailor strategies to individual needs and goals. The exposure of these money myths has sparked significant public and media interest. Financial news outlets, including Bloomberg and CNBC, have dedicated extensive coverage to debunking these myths and educating the public on sound financial practices. Social media platforms have also seen a surge in discussions about financial literacy, with influencers and experts sharing insights and advice. As financial myths continue to be debunked, several potential outcomes and scenarios could unfold. 1. Increased financial literacy. Greater awareness and understanding of financial myths could lead to increased financial literacy. More individuals might adopt diversified investment strategies, protect their savings from inflation, and avoid high-risk speculative investments. This scenario would contribute to greater financial stability and improved economic well-being. 2. Persistence of myths. Despite efforts to debunk financial myths, some misconceptions may persist. The allure of quick wealth and the comfort of traditional beliefs might continue to influence financial behaviors. In this scenario, ongoing education and advocacy will be essential to counteract misinformation and promote sound financial practices. 3. Policy and regulatory changes. The widespread recognition of financial myths could prompt policy and regulatory changes. Governments and financial institutions might implement stricter regulations on high-risk investments, enhance consumer protections, and promote financial literacy initiatives. This scenario would help create a more transparent and secure financial environment. The economic rollercoaster of 2024 has exposed several persistent money myths that impact our financial decisions. From the myth of safe savings to the false security of home ownership and the dangers of get-rich-quick schemes, understanding these misconceptions is crucial for navigating the complex world of finance. By debunking these myths and promoting informed decision-making, we can build a more secure and prosperous financial future. If you found this exploration of money myths insightful, don't forget to subscribe to our channel and hit the notification bell to stay updated on future videos. Share your thoughts in the comments below. What money myths have you encountered, and how have they impacted your financial decisions?